All right. So tonight we're going to be talking about mutual funds. So the reason we talked about stocks and bonds and kind of got into specifics was because you're going to have some exposure to them throughout the course of your life. It may not be your thing to want to trade things individually, to be a active, involved trader, but it helps when you have people, since you're going to have some involvement, like it or not, through your work or pretty much whatever you're doing. If you've got any sort of retirement, 401k or whatever, it's going to end up in the market and probably through a mutual fund. And mutual funds are nice because it takes some of the workload off of you. And so I'll kind of explain what they are, but they're really just components that are made up of individual stocks that are managed by somebody else. And it's good to know kind of what's going on. It's kind of like, when you go to the doctor and they kind of explain to you what the process is and, whatever your ailment is, what the root causes are and stuff. And if you're just completely clueless, it's not a very good conversation. If, on the other hand, you know a little bit about it, you're a little more informed, then you can make educated decisions when they recommend one thing or another, which is important. And the same thing is true in finances. If you see something going on with your finances and you don't quite understand why they're losing money or why they're doing this or that, and you read through the document that's called a prospectus. The prospectus are kind of the rules of the road for the fund manager. And the fund manager is, he's got a certain strategy where he's going to try to make money above what the market would do if he just let the money sit. So he's essentially like a coach or something like that. So there's a bit of skill involved to it, and if he or she is a good market manager, then they're going to do well and they're going to be highly compensated and the rest of it. If they don't do well, then, well, you put your money with another team, or you perhaps put it with an index, and we'll talk about that. And an index just means you buy a little chunk of the market and you just buy and hold. You don't do any. You're not relying on anybody to manage it. You're just into a mutual fund to get diversification rather than buy just a single stock. So the reason why I've left this slide up is this is the Dow Jones. So this is the broader market from 1900 to present. So present in their minds ended about 2015. But whatever, it's kind of continued through. And the thing with this chart, you can, doesn't take much interpretation to see that, yeah, there's ups and downs, there's volatility, but overall that chart is going up. And if you remember when we talked about banking, they were talking about, you're going to get a fraction of this percent, or, maybe a couple percent, or 3 to 5%. The stock market, what's reflected here, and there might be better charts that you could find out there, but anyway, the stock market returns about 10% on average per year, before taxes. Everything's before taxes. But anyway, that's why you're in the market, is because, like it or not, the stock market is, gets a very high yield compared to other things. And if you're, with a company and you've got some latitude on what you can invest in, but it's going to be choices amongst mutual funds that are typically in stock equities, equities at ownership position. So that's why we're in the market. So some people would, hopefully through this class that you've learned that just to sit on your money is not a good idea. Just inflation just eats away at it, just erodes it. And you have to do something with your money. You'll hear it referred to as a hurdle rate, a rate that needs to be accomplished just to break even. If you're not making anything on your money, you're losing money. So why mutual funds? Well, here they show a first couple classes. Stock mutual funds. That's the majority of everything. Mutual funds that are made up of individual stocks, right? A whole bunch of different stocks. It can be a bunch, or just a few. But it just by not having all your money tied up in a single stock gives you some diversification. Also, if you've got a fund manager, they can get in and out of different stocks if they see it being fortuitous. You could also comprise these mutual funds of bonds. So bonds, as we know, don't represent an ownership position. They're not an equity. They're a debit or a debt position. Usually commercial debt, but could be a what do you call it? Municipalities or even the federal government, U.S. Treasuries. Managed by a proportional portfolio manager to decide what securities to purchase. So there are certain times, especially when the market's doing really well, these portfolio managers, obviously they get paid. And so let's say you're making 10%, but their expense fees, because they churned the funds a lot, they bought and sold, and they did different things that all whatever, and plus they all get paid. And if they're very good, they get paid well. So let's say the fund made 2%, but at the end of the day you only got 8% because of all the expenses. So that's why the portfolio manager, their fees are something you evaluate based upon their performance. If somebody's getting killer returns, pay them well. Keep them in. You don't want them being hired off by a different company. But if they're still getting a good salary, being very well compensated, yet the returns are consistently not what you would like, then they need to be fired. You need to move funds. You need to do whatever. So motives for investing in mutual funds. So super easy. Stocks now are getting easier. Like we talked about, you don't have to trade even lots and the whole whatever. The stock market used to be very, I don't know. It was just difficult where you had these people on the floor and they're making these bids and they just weren't set up for volume, and they weren't necessarily interested in the little guy. What we would be, we're retail investors, right? Now, if you're in a mutual fund with, your company, or a mutual fund in general, you're talking an institutional investor or a fund manager who's involved. But just the same, for you at the consumer level, I'll show you the websites here in a little while, and mutual funds are just dead easy. If you want to put in, a lot of times they'll say, oh, it's a $2,000 or $1,000 minimum to get started in the fund. But if you set up a ACH thing, automated clearinghouse, a debit out of your checking account at a regular interval, say $50 a month, they're happy to take it because they know that that's going to build up and be at the 2,000. But they want customers, and they're super. There's literally, we'll talk about Vanguard, Fidelity. There's T. Roy Price. There's just so many different companies out there, and I really don't know of any of them that have got what I call a bad reputation. It's a competitive market. They all strive to be pretty good. You don't have like even the DMV up here isn't that bad, but compared to say like the DMV in California or something like that, those mutual fund companies don't exist. They would get squashed because there are good companies and you don't have to deal with that. So it's a very pleasant experience. They send you nice things. They've got, beautiful brochures and great websites, and it's just super pleasant to deal with. So anyway, diversification benefits. So again, let's say you think AI is going to take off. NVIDIA's just killing it right now. Do you want to put all your money in AI? Perhaps. But also you might say, okay, maybe they're getting a little too high. I know the field is good, There's a couple other companies out there. Why don't I buy little chunks of everybody in that sector? That would be diversification within that sector. And there's different ways to diversify, but that's just a broad thing where all, if you bet on NVIDIA specifically, you've kind of got all your chips on, it's like playing roulette. You've got them all on one number. That number needs to hit for you to win. Whereas if you're on a mutual fund, you're kind of putting it on red. Anything in red. You're confident that red, the AI sector, is going to go up. And as long as it, most of the companies in the red sector do well, you do well. So it's a little bit more conservative in that manner. Portfolio manager, like I say, we could all get really probably pretty good at this. Some people are more skilled than others, but for most of us, it's just we don't have the time. And these guys, this is their job, is to be the portfolio manager, manage this fund. So let's hope that they're, using their time well, their skill, and so now you've got kind of somebody looking out for you, managing the investment. And then specific investment goals, certainly. But again, when you get onto these websites, it'll show a little bit more about that. Rather than you come up with some strategy, they've got all sorts of different tools to help you out. So rather than that stock price, there's a thing called net asset value. All it is all the stock prices put together. So if they own, NVIDIA and all these other different companies under that, bunch of different AI companies, what they do is they get their positions in all those companies, so they've got whatever number of shares in each company, and they do the math, and then they come out with the net asset value, which is the combined average value of what they got in those funds. So, it has just a share value. So if you're trying to figure out how your mutual fund's doing, you just look at the ticker symbol. Each mutual fund is just like a stock in that way. It's got a ticker symbol. You type that in, and you can see what the performance is. It used to be that net asset values, because of all the different math involved, since they have so many different positions, it was only calculated once a day. But now it's typically calculated, on a real-time basis. The one thing mutual fund companies don't like, though, is they don't like their stuff to really be traded. So when we talk about investing is kind of a long-term approach. Trading is more of a, just trying to make money by swapping things back and forth, typically on a fairly quick basis. Sometimes you'll find with mutual fund companies, if you make more than, say, 1 or 2 trades a month or 1 or 2 trades a year, they may not allow it. They may say, nope, you're restricted, and, because that portfolio manager, he's got a certain chunk of cash, whatever number of billions or millions of dollars. And if that amount is changing all the time, it makes it difficult to do execute strategies when the value of the fund, the assets under management is going up and down all the time. So they're a little persnickety about that. Load versus no load funds used to be a thing. There are still load funds out there. If somebody comes up to you and says, hey, I've got an exciting thing for you, and you need to get, that guy's a salesman, right? And he expects to get a commission. So a load is probably going to be out there. You don't need that. You can do your own whatever. Buying stocks, doing the research is not hard. You don't have to pay a commission for somebody to log onto a website for you. And the problem is that commissions come on the front end. And so it does have a big impact. It can only be, say a few percent here and there. But when it's taken time value money and all that, we know that money you put in early is going to have the longest time to work on it. Well, that's the part where they took their commission. So that's painful. Here's a comparison. So this guy, $5,000, no load, good job. So put in 5,000 divided by 20, got 10%. Woo-hoo. So $5,500, right? Same individual, he was lazy. He paid a commission, right? $200. So $4,800 invested, 240 shares. On the $5,000, didn't make quite as much, right? So a $200 commission, and his return went from 10% down to 5.6. So above inflation, below inflation. So anyway, no reason to be in a load fund. In fact, they don't even make such a big deal out of it anymore. It's just assumed that it's a no load fund. But if you're buying it through an insurance company or something like that, if there's somebody reaching out and giving you, holding your hand while you go through this process, maybe you need to do it the first time. But I would argue from an industry perspective, there just aren't that many loaded funds anymore. Expense ratios. So they're saying expense ratio of 1.5%. So the management fees, 12, just more administrative fees, legal, clerical, all that different stuff. Now there is a way to get these fees down if you want, if the market itself seems to just be going up, and this will be part of your homework assignment. There's a podcast that's still relevant. It's getting to be a little dated now, but Warren Buffett, Oracle of Omaha, very famous guy, Berkshire Hathaway. He and the guy from Vanguard have a little competition, and Warren Buffett is saying index funds, where an index funds means, let's say there's an index like the Standard & Poor's or the NASDAQ, and let's say I think technology is going to go up, so I want to be involved in the NASDAQ. And so I want to buy an indice that's maybe got, I think it's got the top 100. I'm invested in one of these. It's called QQQ, right? Pretty famous. It's an index fund, so it's got certain shares in there, but they don't do a bunch of swapping back and forth. It's actually an ETF, so maybe I'm crossing the streams here. But the index fund just means that they buy individual portions, fixed amounts within that whole index. So the Standard & Poor's, S&P 500 stocks in there, they're going to buy a certain number of shares of all 500, whether it be in dollar amounts or share amounts. But anyway, it's going to be a fixed amount, and they're going to hold those shares so you've got exposure to that entire index. And if you want to retire early, be a portfolio manager for an index fund, because that's not a job. There is no work. You buy all these shares, your first day at work, and you're done. They don't trade. They don't do anything. They just sit there and go with the market. Whereas a portfolio manager would get in there and try and buy a little more of this and then buy that and do some of the things we talked about, short selling and options and all these more complex things. But, of course, that complexity has some risk, but it also has a built-in expense ratio for doing all this work. Expense ratios, yeah. This is a generalization. I don't necessarily, this fits at a certain time, certain market conditions. Low expense ratios tend to outperform. If they're all doing well, obviously the low expense ratio means that they don't have that expense. So if both funds are getting 10% and one's got a lower expense ratio, but the whole reason you have a portfolio manager is because that person is supposed to outperform the market. If they're not outperforming the market, yeah, they shouldn't be a portfolio manager. They should find what they're good at and perhaps do that, because portfolio management doesn't seem to be they don't seem to have an acumen for it. All right, so types of mutual funds. So, like I said, I talked about a sector before, like say AI. Here, mutual funds they're a product that's an assemblage of, in this case, stocks, right? And so they're going to assemble them to make something that people want to buy. So it's all marketing, and the names will shift around, and that's why their absolute definitions don't really fit. There are some broad classes that we can use, but you will see different growth funds referred to in different ways in terms of marketing spin. But a growth fund means stocks from companies that are growing, right? And so that is not something that you would expect to pay a dividend, because any profits that corporations makes are going to be reinvested. But what you do want to see is that share price grow. And so that's very much related to this next one, capital appreciation funds, focused on stocks that are expected to grow at a very high rate. So almost synonymous. So they're trying to split hairs here. Pretty difficult. That's not going to be what I will have on a test, for example, will be a growth fund versus an income fund. Income or more established companies. Income means they're paying you an income in form of a dividend, meaning that the company's not so much in a growth phase, it's mature, and rather than reinvesting their profits in new plants and expansion and all that, they are able to pay a dividend to the shareholders, which would be you. Whoops, sorry, jumped right over that. They can also be quantified into their capitalization. So small caps, there are numbers that go along with this in terms of millions and stuff, but it's, anyway, small caps, mid caps, and then there's large caps, which would probably be typically, well, it doesn't mean that they're not a growth company, but anyway, I know they leave that out on the slide. But anyway, the capitalization, so a small one, probably maybe a little riskier, but risk is related to return. Mid cap means it's pretty well funded, a little more established, medium-sized company, probably a little less risky. Probably, the return, those could be moderated a bit. And then equity income funds, whatever they want to talk about. That means that they're not necessarily a growth. This is the one that's paying a dividend. Balanced growth. So again, we can just combine these however we want to do it. Growth and dividend. Ooh, why would I want that? Anyway, all these things are a trading thing, and you just to look at a broad classification, you want to look at ratings, you want to look at the prospectus, which tells a little bit about the fund and their performance. And there'll always be the caveat, past performance is not indicative or not certainly indicative, or what, there'll be some qualifier. But, if it's a failing fund, that's probably not one to invest in. If it looks like it's on a steady trajectory upwards, that is probably something I'd be interested in. But I'd want to do a little bit of research just to make sure it's not a one-off. If it's some portfolio manager who's doing really good work, I want to make sure that person is still there. So anyway, you can look at the performance. Then also, there's, just like in other companies, a third party. In this case, it's Morningstar. Morningstar does reviews of mutual funds. There's other people who do it as well, but Morningstar is kind of the big boy. So there'll be a Morningstar ranking. And if it's, a place where you want to be buying mutual funds, that Morningstar ranking will be easily available. If it's not, then question why it's not. They have to pay. Morningstar, obviously a subscription service, but if you're generally an account holder, it's included. You're not having to pull out your own subscription to Morningstar. You can use the Morningstar data that's provided by your brokerage. Sector fund. So these can be all kinds of sectors. I mean, it can be I already did the specific industry. I talked about AI, but it could be medical. It could be geographic as well. All kinds of different ways sectors can be split up. Index funds. So attempts to mirror. So they can mirror it. They just buy a little segment of each one of those companies. International. So believe it or not, there is a difference between international and global stock funds. If it says international, the company can't have a presence or can't, be based in the U.S. global means it can be anywhere. So slight difference there. Socially responsible. So again, this is, in the eye of the beholder. We could discuss all day. It is kind of a political season, but you say, oh yeah, I want to get involved in that one because they build EVs, but is, mining batteries, well, whatever. I'm just telling you, there's sometimes some controversies in what's responsible and what's not. So again, you need to read this prospectus, you need to look at the holdings, and you need to kind of decide for yourself. Other types, small cap. I mean, you can combine them however you want. I mentioned ETFs before. They can be related to index funds. That's how I'm using it. And what happened with ETFs is mutual funds, they have such a large percentage of assets under management that, the stock market folks, the actual guys at the broker or at the exchanges, they're kind of missing out on the action. So they tried to set up something that could be traded quickly and was more for traders, if that's what you want. And it had that instant prices from the get-go. Now the difference between ETFs and mutual funds, not that big a deal. I've got some crypto in ETFs. There aren't necessarily. Well, I do have a crypto mutual fund as well, but it contains some of the infrastructure people, the miners, the people who mine the coins. Okay, so we're going to look at a few of these. Vanguard, good company, like I say. All these companies are pretty good. So these things too, when you're trying to do your term paper, which we're going to talk about here in a while, there's all kinds of good information for us, for what we're doing, probably in the personal investing section, and then resources and education. That's always good. Investment types, this takes it at a pretty basic level. It's got some advanced stuff if you want, but if you're trying to do your term paper, not bad. They want to try and do some of this AI advisor. If you're a high wealth person, get on the personal or probably personal advisor select for you. But anyway, let's look at some mutual funds. So again, all these sites, well done, nice pictures and stuff, how to open an account. So just because I'm on a Vanguard site doesn't mean that I will see just Vanguard funds. They're going to try and steer me that way. They'd love for me to buy, all these Vanguard products, but they also want to be my one go-to place, where I can get everything I want. And so, if I go non-Vanguard, just down here, general mutual funds, they should show me a few more. Oh, Abbey Capital. So they're making it a little more difficult. Now I got to select from, you can see, it's a competitive market out there. So if you want to charge a load, good luck. There's some competition, This is not as much of a user-friendly site as I'd like to see. I want them all out there at once so I can rank them, look at them by Morningstar. But, I'm going to look at Fidelity here in a second, right? And I should see it. So, that's their competition. So you can buy Fidelity mutual funds on the Vanguard site because, again, they want you to have your account with Vanguard and they want to be your, not have to go anywhere. And some of these that say closed, some funds as well. That is a strategy where the fund manager, if you're the 10,000 pound gorilla, and let's say you're in some mutual fund that's trying to invest in technology, and you've got billions of dollars under management, and you find this niche little company and you want to invest in it. Word gets around that you're invested in it, and you will completely distort that stock price. It'll go nuts. So they a lot of times will close funds to keep them at a certain level, and stuff. Also, one thing that we're seeing here, well, we'll go to the Fidelity side just to give a broader range here. So accounts, we'll look at their mutual funds as well. So you might find one site you like better. In reality, you'll probably find your company you work with is already associated with a company, and you're going to go with them, and you'll be just fine. So, yeah, from the get-go, I kind of like the way, they're doing this. They've got Morningstar info. Not that I've got anything selected just yet, but 90, there's enough funds here to look at. Now, Fidelity funds, obviously, they'd love for you to just stay there. Fund picks. Sustainable. Remember how we talked about that? Minimum investment below 2.5, $2,500. And, transaction fee. So they'll even, you could jump in all 10,000, or you could go down here and go, well, I'm looking for Fidelity. Any provider doesn't charge. Again, they're going to try and keep you with their own stuff, but I'm not going to pay a fee. Select. Risk is related to return. So you want higher returns, potentially riskier. One fund that fully diversified, safer, low expenses. What are you after? Giddy up. Beat the benchmark. So anyway, they highly rated by Morningstar. This is no matching funds. Yikes. How did I get there? Fill in the props. Yeah, out of 10,000 funds, there's nothing that... What's wrong with Morningstar? They don't like these funds? Let's see what's going on here. No matching funds. I screwed something up. Anyway, so yeah, again, this might, I'm talking about how great this site is, and now I'm kind of flummoxed. Oh, matching funds. Anyway, so I've got some criteria in here that I haven't quite done right, but the big picture is Morningstar data available. Let's look at a few. So I talked about different ways that you could look at different categories for mutual funds, right? So equities, municipal bonds, so bond mutual funds if you wanted them, money markets, non-traditional sector equities, taxable bonds, and then you can expand out of that. So these things can be differentiated. Let's say you want municipal bonds, but yet you want something in a particular state. I mean, you can just go down in the weeds on this stuff. Taxable bonds, large growth, small growth. Let's see what they've got under large growth. So 2,600 funds. Let's see which funds they've got available. Obviously, the Fidelity ones are going to be up front. Well, I want the one with the highest Morningstar, right? Yeah, these are overall 3-year, 5-year, 10-year. So a track record is good. You're looking at the yield after 1 year. Nice. Helps to be an election year. 3-year, that's inconsistent. They did really well this year. 10 years are getting 17%, not bad. Over 10 years, life of the fund, 13%. So when I said 10%, I'm not kidding. You can get those yields, 12%, 11%. There's a dog at 6%. You're not getting anywhere near that in a bank, So it's been a pretty good run. And then the different number of stars on Morningstar, expense ratios. Anyway, a lot of information here, so you can just kind of dig through it. I'm not going to, try and knock it all out in a night, but I'm just saying that there's a ton of information and good information that, let's look at this. Blue chip growth. So blue chip growth means large growth companies. So companies that are still growing. More information, you dig down in here. You've got the charts, the prospectus. Remember when I was telling you about kind of what their strategy is? Objectives, tables, all the info. There's a legal requirement for them to provide this to you. And this is where you do your due diligence and you decide if it's right for you. What I'd like to see is what companies are held under that. So that should be top 10 holdings right there. So NVIDIA, Apple, Amazon, Microsoft, Google, Meta, Marvel. So, they've chosen some pretty big, good companies. You would feel pretty confident. Now, let's say you think you're going to diversify. So you get the growth fund from Fidelity, and then you get the big growth fund from Vanguard. You're probably going to see under the Vanguard fund that it has these same holdings, because these are the Magnificent Seven are these top ones. So, yeah, a lot of the stock performance has been kind of distorted by the fact that there's about 7 companies that are just knocking it out of the park, and the rest are kind of just getting by. Some of you may be more come across. Robinhood's got pretty aggressive marketing, and they do crypto as well. They do gold. They got credit cards. They may have some incentives to get you in there, and it's obviously one of the newest ones. I've never dealt with them, but it's certainly an option. But anyway, you're not going to find that your company's necessarily associated with Robinhood, but Robinhood definitely caters to the retail investor. So, kind of cool stuff. All right, where were we? So we looked at some of the sites, tons and tons of data, and it's, you can troll around there. You could go through that mutual fund and find out why it wasn't showing any funds. Out of 10,000 funds, I guarantee you there was something in there. Bond funds, so again, these are debt positions. We've got, these are federal things, treasury bonds. Ginnie Mae, these are mortgage and corporate bonds. So corporate bonds, obviously, they can go out of business. Corporations can go out of business. If the federal government goes out of business, yeah, that's not a good situation. They're not going to pay much in the way of a yield to you because you're not exposed to very much risk. Mortgages used to be considered ultra secure. Now, there's good, but corporate bonds, they got to pay a little bit more because there can be some default, meaning that they go out of business. And then, yeah, you can get junk bond funds. But if you're diversified, if you got a bunch of junk bonds, rather than buy a single company, it might be a way to invest in those and get some exposure and get the huge rewards and maybe mitigate the risk because the odds of all those companies failing is lower than an individual company. But again, you get kind of back to the 2007, 2008 strategy where they had these municipal, these collateralized debt obligations that were just a big pile of junk, and they mounted them together and they failed. So things can happen. Municipal bonds, yep. Sometimes there's tax-free municipal bonds. Can be attractive to people if they're in that sort of tax situation. If you're not paying much in the way of taxes, then they're less attractive to you. So you have to do a bit of math to figure out whether that's a good deal or not. And then bond indexes, just same as any index fund. They don't really do a whole lot of trading. They just buy the ones. International bond funds, so outside of the U.S., global bond funds, anywhere. And then they can also do different maturities. One thing, too, that you'll see on mutual funds when you're looking at them is there sometimes can be categorization ones that came out. It's probably been 10 years or so now they've had them, but it'll say like target date of 2065 or something. And that 2065 would be somebody who's going to retire in, what would that be, about 40 years from now, right? So there'll be a date when you're going to start drawing money out of that mutual fund, hypothetically. You don't have to keep it in there, but they will manage that fund with the thought that it's going to get more conservative as it gets out towards your target retirement date. So mutual funds are, there'll always be new things where somebody will come out, and if there's a market for it, they will make it available to you. Investing in a mutual fund, yep. Typically, you just check these boxes to reinvest your dividends and reinvest your capital gains. As they're buying and selling stocks or they're holding stocks, they'll get dividends. And you don't want a bunch of little silly, fractional checks coming to you all the time. Most of the time, you just check that they reinvest, and they'll put them in your fund. You could actually, get these small disbursements, but it would just be hard to do. So I've never done that. Capital gains, yep. If it's just like selling a stock, if you buy it for one price and you sell it for more, that's a capital gain. And if you kept it more than a year, it's a long-term capital gain. Less than a year, short-term. So exactly the same on that. Yeah, so ST, short-term, LT, long-term. 15% on long-term. 28 could be. This is your individual tax rate. You're basically what you're paying on the rest of your W-2 income. Yeah, the risks are the same. Market risk, general stock market conditions. It's based on the underlying, assets that it holds. So, what you need to make sure is risk is not a bad thing because it's related to return. If you don't want any risk, then you don't get any return. What you want to make sure is that you aren't in a position where you've got a lot of risk and very little return. That's not good. So, yeah, the high risk would be a growth stock fund because it's a kind of emerging company. It's all tied in one sector. So high return, high risk. But if that's, I don't know, I've gotten slaughtered in medical stuff. I won't touch anything medically related. I've just never done any very well, and I've always done real well in technology stuff. But I think that's just me. Clearly, some people are, make money, but it's more complex in biotech stuff, I think. And risk investing in bond mutual funds, same as investing in the bonds. But the only thing about all these mutual funds means that, a single company failure is not going to tube your investment. You don't have all your eggs in one basket. You're diversified. And oh, by the way, you, most cases, have an active portfolio manager who's supposed to be watching things for you, not letting things, they're supposed to be trading as necessary. So, potential return, they're showing this is, low potential return, low risk. Index fund was that representing a broad index. So, again, this is kind of a generalization. I do very well on an index fund because the index I'm in is technology focused. It's broad, NASDAQ is pretty broad, but if you're in everything, if you've got everything from General Motors to Nvidia, yeah, that's going to kind of muddle things. But typically, you can get an index fund on an index that's can be fairly aggressive. Anyway, income fund, yep, because they're a larger company, established, paying high dividends, balanced growth, global technology. Technology's always kind of viewed as riskier, but that's where a lot of the gains are. You saw that Magnificent Seven we talked about. What were they? Meta, Nvidia, Google, or Alphabet, whatever. But anyway, that's where the returns are. Foreign stock growth. It's a good thing to, I'm not trying to be jingoistic or nationalistic, but it is a good thing to be in the States. Now, if you've got an idea that someplace like, hey, India, perhaps Vietnam, something's taken off, and by all means, you can find a mutual fund that invests in that region, and you can jump right in and get that exposure. The problem, though, with foreign stocks is, number one, that but China's not necessarily the same economy. China's a big economy, but they're not getting the yields that the U.S. markets ever have gotten. But anyway, by using a mutual fund, you don't have to deal with the currency things. You don't have to deal with the legal stuff. So you could, for example, let's say you invested in Turkey and you made $1 billion. You made a ton of money. But I lived in Turkey for years. And they come out and they print the bills, and they just add another zero on every couple of years, and they just accept it. So if they're holding cash, you can make a ton of money, but by the time they do the currency switch, your poor stock can get clobbered. So there is more risk when there's being international like that. Other things can happen. Bonds, same sort of thing. So lower risk when it's shorter term and it's government security. Higher risk when you're holding, junk bonds for a long time. You're giving that bond a long time to fail. Yep. Same sorts of things. And here again. So short term, less risk, government securities, high risk, junk bond. So yeah, really you can spend quite a bit of time to look at what your objectives are first, and then find a prospectus or whatever that matches that. Make sure it's something you can live with. That chart I showed you about the stock market going up and down and being volatile. If you've got, paper hands, lettuce hands, whatever you want to call them, and you sell at the bottom and you panic every time the market shows some volatility, that's not a winning recipe. You'll get out at the wrong time. So you have to make sure you've got an investment that you can not only get some sleep with, but also one that's not going to make you so panicked that you're going to make stupid decisions and sell in a panic and destroy your potential earnings. All those up and down type stuff, generally you just ride it out and you'll be just fine. So we talked about prospectus, investment objectives, performance. We saw how you can look at that. S&P is kind of the benchmark. So when you look at volatility, for example, there's a notion called beta. The Standard & Poor's 500 when you're trying to say whether a mutual fund is or a stock is volatile or not, it's kind of hard to say because there's volatility within the market. So you need a reference point. It's like being on a boat and saying we're really getting knocked around compared to what? I mean, it's not going to be steady. The water's going to have some movement. So you need a reference point. And that reference point in stocks is the S&P 500. And rather than say the volatility reference point is this, they say beta. Beta is by definition a value of 1, which equates to the volatility of the S&P 500. So if a stock is like 1.5 beta, that means it's 1.5 times as volatile as the S&P 500. If it's a 0.5 beta, that means it's half as volatile. So volatility is, something you might have interest in knowing, and the reference point for that would be beta, and the reference marker for that is the basis for that is the S&P 500. Talked about loads. Hopefully you're not paying it. Sometimes there are back-end fees where they take a little something at the end when you're withdrawing the money. I don't want them taking any money, but if they're going to, at least this way they've got a little skin in the game. They're trying to enhance the value of the fund because they make more money and they don't have that time value of money problem. So anyway, risks. You've got involved in mutual funds to mitigate some of the risk by diversification. And then you'll need to make a decision on distribution of dividends and capital gains. And generally, let them just reinvest and make it seamless for you. Minimum investment. Almost all cases can be waived if you set up a regular program. How to buy and redeem. Dead easy. Log on, type in your password, and do it. Yeah, we don't have that table. We already looked at Fidelity's site. So, again, they don't have the advantage of having access to the sites like we did. So we can get so much more information off of the website. This, like I say, mutual funds are quoted with ticker symbols just like regular stocks. So this one's paying a dividend. Last price, and it was up 17 cents. There's also, if you want to get away from individual companies, the Mutual Funds Education Association. Anyway, it's an organization that's formed by all the companies, but the regular companies their products are pretty good. I would see a need to do that. You can get various mutual funds, but again, look at the underlying assets to make sure you truly have diversification. This thing here, some people, because I don't hold bonds. Bonds just, there are bond traders out there. They make quite a bit of money, but I've never been one to hold bonds. And so I'm not going to buy bonds just to say that I own some bonds. There's a certain concentration you want when something's doing well, and there's diversification when you're defensive. But unless I thought bonds were going to do quite well, I wouldn't be involved. Right now, bonds are the interest rates are quite high, and might be a time to get in maybe a long-term bond that's paying well, because as interest rates fall, if they do, your bond might become more valuable. So, but I'm still, even though this might be an attractive time to buy bonds, I'm the regular market, stock market is, the yields are just more. Diversified in different regions, although they're quite interrelated and quite dependent upon the U.S. Yep. Yeah, so, when one country sneezes, everybody kind of gets a cold. If it's the United States that's got some economic difficulty, it's generally going to be reflected. Maybe things will change, BRICS and all the rest of that stuff. There may be more independence, but right now, not so much. So we kind of looked at this. We kind of looked at what they would call a mutual fund supermarket. They sell other people's stuff. 10,000 funds. Probably going to find one you like. Yeah. So, gross U.S. stock fund. Yep. U.S. market. Europeans. Latin. Australian. The Canadian thing, be careful with that. Canadian stock market can be kind of the Wild West. There's a lot of mining stocks up there, and it just has a reputation for perhaps being a little. And again, I did quite well on Lululemon, and it's a Canadian company, but I bought it through a U.S. exchange. But primarily in the mining sector is where it just gets crazy in the Canadian stuff. So, hedge funds, theoretically, hedge funds are supposed to be kind of contrarian funds. You've got a lot of money and you're making money in one thing and you want to hedge your bet. You want to bet against something. But hedge funds a lot of times are high wealth individuals that will jump in and do very strategic investments, and but again, it's dominated by a few very good players. People are very experienced, and they're usually not dealing with retail investors. Bernie Madoff, yeah, he was a scammer, but this was a thing of due diligence. What happened is these people were getting 20%, annual returns with no risk at all. That doesn't happen, and so it was just a Ponzi scheme. He was just taking people's money and giving the incoming money to the existing shareholders, and as long as you had a steady flow of new people coming in, there was money to go around. But when people started trying to withdraw, all of a sudden there's a house of cards that fell down, and he went to jail. Bernie Madoff. So, I just wanted to go back and look at just a couple other things while we're see if there's a couple other mutual funds to look at. We looked at the holdings. I wanted to see if there was a couple different sectors on here. So we'll go back to mutual funds, to the general page. I mean, these guys will even do crypto now, direct. I don't think they'll enable you to do custody, but sector equity, U.S. equity. Let's look at this real quick. Oh, that's what I was doing wrong. I hadn't selected anything off to the left. So you can figure out what area you want to be involved in geographically, and you can find a fund that is going to, match your constraints. Let me just do a quick thing here. No, it's not going to do it. I thought maybe there'd be a something specifically like for Vietnam or something like that, just to show you an example of how diversified this could get. Well, here's where they're fund type by region. Yeah, so you can drill down on these menus. You can also get into what I was talking about with the funds that are timed. You'll see a date specified in them, a target date, and those will be those ones that are set to sort of adjust your fund as you get closer to retirement. So anyway, well, maybe another time we'll take a look at that again. I want to get to the homework part. Okay, so when I was talking before about a tax-free municipal bond, and somebody goes, oh yeah, you always want that because it's tax-free and that's a better deal. It's not that easy. What you have to do is just a little bit of math, and so we could even do it in our head. Okay, so for this first question, prefer a fully taxable bond at 10.2%, earning 7.9 that's tax exempt. So which one's better? So a 28% tax bracket. So for my example, I'm just going to round this number off so I could do it in my head. Let's say it's earning a flat 10%, fully taxable, and you're in the 28% tax bracket. How much of that 10% do you get to keep? All but 28%, right? So you subtract 28 from 10 or 100, whatever, you would get a 7.2 rate is what you're left with. And you compare that to the 7.9, you would take the 7.9, right? Because you're only making, even though you're getting 10%, like I said in my example, after you do the math, you realize your actual, amount you're allowed to keep is only 7.2%. So 10.2%, slightly higher. Do the math. I'm not going to pull out a calculator, but that's how you do that. Here's another stock program, no big deal. Here's a economy with a corporate bond. So these things, the bonds are kind of interesting. It doesn't take that much to figure it out, but I've talked about this before. If interest rates are high, and you've got a bond, if interest rates start to drop, your bond that's paying that higher yield is worth more. The new bonds coming out competitively are paying a lesser rate. So let's say you had a $20,000 bond that's paying 7% interest, and the new $20,000 bonds are only paying 5% interest. Well, you could sell your higher interest rate bond for maybe $21,000, something like that. So the interest rate affects the value of your bond if you sell it in the secondary market. You could choose to just keep it till its maturity, in this case, maybe 20 years, and then you get 20 grand back regardless. But if you sell in the secondary market beforehand, depending on what the interest rates are, depends how much you get for it. And then another math problem. So that's that. This is the podcast I was talking about. So it's going to be, I guess we can go back to this. So there's a podcast out there. You'll listen to it. It's, Warren Buffett and the guy from Vanguard. And they go through and they, kind of lay out what index investing is versus what active investing is, and then you just kind of give your impression, what you think works. So it's getting old. It's from 16, so it's 8 years old now, but it's still pretty good, and the concepts haven't changed. So the term project, I'm actually having people starting to take me up on it. Send me a copy of what they're planning to submit. Good to go. Again, get started on it. It's not a hard project, but if you put it off and then hand me, a page, page and a half, it's just not going to work. You're not going to get the grade you want. People just, again, I don't think they they want a certain amount of freedom, but they really don't. They want to be told exactly what to do in some sort of cookie cutter approach, and that's not how this plan works. This plan is for you, for your specific situation or what you forecast your situation to be. So in there I talk about 5 years from now. That's just because for a typical person, that kind of makes sense about 5 years out. But if you're already embedded in your career, you're already making money, then by all means, start it right now. So that's about good. What else? I guess that's about it. Today was a rough day for me. Let me show you something. Oh boy. I stuck my snow machine in the river. But a little hard work. Pulled it out. Broke the ice off it. Spent the night out there last night. I didn't. I walked home. I said, let's chip the ice off. Towed it home. And we're off. Amazing machine. Anyway, have a good one. Don't stress about the election. It's probably over by the time you're getting to this, but we'll see.